In this video, I'm going to look at calculating product cost and use case 663 as an example. First off, don't get overwhelmed by all the detail. It's just a setup to tell us we're a company, we're looking at exploring the product cost of one plant versus another, our older plant, Fredericton, and our newer plant, Monktown. Again, looking at comparison. Now, when we talk about product cost, that's going to include direct material, which they already give us, direct labor, but that's also going to include manufacturing overhead. So we have to understand how are they estimating and applying overhead. They tell us plant overhead is allocated based upon estimated production. And then if we keep scrolling through this fourth paragraph, it says production is measured by direct labor hours. So our predetermined overhead rate is going to be based upon direct labor hours, and that's how we're applying the overhead. I'm going to work with you on calculating Monktown, and I'm going to allow you to calculate Frederickson on your own. We're going to start with, again, product cost. What is that for Monktown? $25 in direct material is going to be our starting point. And note, irrespective of what plant it's produced at, this company has negotiated a raw material price of $25 overall. The next item is going to be direct labor. That is going to be dependent, that cost is going to be dependent upon location. We can see Monktown takes 3 hours versus Fredericton takes 4 hours. My guess is that Monktown, the newer plant's more automated, it takes less manual time versus Fredericton. We can also see there's a differential in the wage rate. For example, it's $9 per direct labor hour for Monktown and Fredericton is 10. My assumption is there's more senior. Frederickson's been around a lot longer. There's more senior individuals who are at a higher pay rate overall on average. So for Monktown, our direct labor per unit, keep that in mind, is going to be the 3 hours per unit times $9 per hour is $27. That's the starting point of product cost, direct material and direct labor. The last item we have to add in is manufacturing overhead. Again, we've got a lot of detail if I look at my table here to the right, and not all of it do we need. It's just their extra information. For example, the information listed under the column for corporate administration is not something we're going to include within our product costing. It's marketing, R&D, depreciation related to the corporate office, perhaps in general administration. That's non-manufacturing or period cost. It's expense, not allocated to the product. We are concerned, though, about our manufacturing overhead. That's going to be our supervision for Monktown of $100,000 and direct labor of $200,000, depreciation of $600,000, and miscellaneous overhead of $100,000. That adds up to a total of $1 million estimated overhead for Monktown. Again, our predetermined overhead rate is going to be based on direct labor hours. So we're simply going to take our estimated cost of $1 million for Monktown divided by our estimated production in direct labor hours of 100,000 and calculate that our predetermined overhead rate for Monktown is going to be $10 per labor hour. Again, if we read back through the scenario, they do point out, obviously it's going to be different from the other plant, so you're going to have to calculate that separately for Fredericton. So to go to apply the overhead to a unit for Monktown, again, it's applied based on direct labor hours. So we're going to take the fact that there's 3 direct labor hours per unit, multiply it times $10 of overhead per hour, and that's going to be $30 of overhead we're going to apply to a unit. Add that to the direct labor, $27, the direct material, $25, and we have total product cost of $82. Now, I will say, the inclination may be, oh, newer plant, more automated, it's going to be less costly. I'm going to leave you to calculate Fredericton and prove that out.